How's it going, guys? Today's topic, I want to discuss in detail, what should I do with my 401k when I retire? So the individual watching this video has accumulated their retirement savings into a vehicle known as a 401k account for the last 10, 20, possibly 30 years. And now you're kind of at this X point where you're saying, okay, I know I'm either nearing retirement or I'm currently retired. How can I leverage this account properly to make sure that it's in line with my goals? So in this video, I'm going to be discussing what are some of the options that you may have available to you? What are the most common problems that individuals have when going with the wrong route that does not suit, their main retirement goal? And then what are some solutions to make sure that you're creating the proper strategy so you have that stress-free retirement? How could you make sure that you're able to spend money every single month, every single week, every single year like clockwork, but still make sure you have ancillary accounts set aside for emergency needs, set aside for growth and inflationary needs in the process? So simply put, when somebody's no longer working for their employer, they now have options that they could take the dollars from the 401k account or leave it alone. So how this account grew was the contributions you were placing into the plan, any sort of matching money that was going in there from the employer, and then the rate of return that came back based on the different investment options that you chose. So if you're no longer working at that company, there's no longer a match that's going to be set up for your account. So you're no longer making contributions into it and you're no longer getting a match. So therefore, the growth rate, which is going to be important to decide how large or how small this bucket grows or shrinks to, is based on the different investment options that you could choose. Typically with 401k accounts, there's going to be limitations to those options. The really good things about 401k accounts is for that matching money, for those contributions. It's kind of one of these out of sight, out of mind type vehicles. Okay, I'm making X amount of dollars per year. I'm taking X amount of dollars from my paycheck. It's always going into this sort of retirement vehicle, and I know that it's being set up for my savings. Well, now you're getting to that end date, and you're saying, okay, well, now this nest egg is nice and fat. What do I do from there? So you can either leave it alone, try to create a withdrawal strategy by leaving it in that 401k with the limited investment options you have. You could cash the dollars out, meaning you take the full amount and just dump it into your checking savings account, which could be a tax disaster, or you could do something known as a rollover, where you take the dollars from the 401k, you roll it over because it's a qualified pre-tax retirement account, you roll it over into a traditional IRA. So it goes like to like terms, there's no taxation on the rollover, but now when it's set up in an IRA, you have all these customization opportunities. You have thousands of different opportunities for customization. So when you go and you roll the dollars over into an IRA, it's an individual retirement account. Now you can create a strategy to say, I want to make sure my income needs are met in retirement. I want to make sure I have emergency needs are met in retirement. And I want to make sure that my growth and tax situation is met in retirement. And a really easy way to remember that is something known as the PIG method. It stands for payments, immediate, and growth. Step one is payments. You want to make sure that you're getting paid in retirement with some sort of cash flow. The number one source of income that individuals have, especially when they work for a private company, is typically payments through Social Security income. Is your Social Security income going to be greater than or equal to what your expenses are throughout retirement? Majority of individuals, majority of Americans, that answer is no. So what sort of strategy, what sort of specific income strategy do you have to leverage with your 401k account to make sure you're using the smallest amount of dollars and only as much as necessary to produce some sort of lifetime income cash flow to close up that gap? So as an example, if I'm getting paid $40,000 of Social Security income, but my expenses are $60,000, and I have a $500,000 401k sitting here, well, it may make sense to roll over the $500,000 into an IRA, and then you customize portions of that IRA into separate IRAs that would create or accomplish your cash flow need. So in that example, if you have a $20,000 gap, you may want to take $200,000, create the proper income strategy, and now that will produce the $20,000 of lifetime income. What happened with that step one? Once step one was covered, now you can move on to step two, which is your emergency needs. Rule of thumb is an individual should have anywhere between 6 to 12 months of what their expenses are into some sort of liquid account, some sort of account that they could pull at the drop of a hat. So in that scenario, if let's say $60,000 was an annual expense need, maybe they leave $50,000 into some sort of liquid account, such as a money market account. So it could be an IRA that's customized to money market accounts. With that portion, what do we do? Out of the $500,000 total, $200,000 went to the income need, $50,000 went to the emergency, the immediate need, and now you had step 3 for that growth and tax related situation. Now that has all those ancillary dollars, $250,000 remaining, that now you could really grow those accounts. So rather than try to commingle it and say, I need all this money to go to an income need, I need all this money to go to a growth need, or I want to leverage a growth related strategy but try to peel off some dollars, that's where it could be a retirement disaster, a retirement nightmare. So what are some different problems that individuals come into contact with, and how do you stop those problems? Well, the first problem is someone not taking advantage of the rollover opportunity. When an individual is working for a company, they may, when they hit age 59 and a half, their employer may allow them to leverage something known as an in-service withdrawal or an in-service rollover. Other companies may not allow that. So based on how your employee benefits was created, how your 401k account was created, you may have the opportunity as you're still working, as you're nearing retirement, to take the dollars of your 401k, up all or a portion of it, and roll it out into an IRA so you can have all these customized opportunities. When you no longer work for that company, now you do have that opportunity to take the dollars, take advantage, and roll those dollars out, as opposed to just being caught between a rock and a hard place. If you stay within that 401k account and you have limited funding options, think of funding options or investment options as eggs in your basket to choose. Does it make more mathematical sense to be stuck with 20 to 25 different investment options to choose, or to be stuck with 4,000, 5,000 different investment options to choose? Obviously the latter. So that's just on a growth perspective, but there's all these little minute differences that you could leverage, all these customization opportunities that you could leverage with IRAs by rolling over the 401k into those IRAs, that could be very powerful for an individual situation. Also, the next problem is really placing too much money in the wrong area. I mentioned the PIG method: payments, immediate, and growth. The trick is to use the smallest amount of dollars and only as much as necessary to create your proper payment strategy. How exactly can you make sure that you're peeling off enough cash flow off of a segment of those dollars that could last you for the rest of your life, either you or you and your spouse for the rest of their lives, but you're only leveraging a sliver of that. That's step 1, that's the payment. Step 2, the immediate need, the emergency need. What's the smallest amount of dollars, only as much as necessary, that you have to put into that immediate related strategy? And then really step 3, the growth. The major goal should try to be as much leftover monies or ancillary or growth related dollars as possible. If you could leave the bulk of those dollars in that third step, that's how you know you've won the game. But the hardest steps is to make sure that you're creating the proper distribution strategy and effective emergency strategy. But once you accomplish that, it's giving you your safety net. It's giving you that peace of mind that you can live every single day without financial stress, without deathbed regrets, and live the retirement that you've always envisioned. Third problem is taking on too much risk for income and growth strategy. So you don't want to throw too many dollars towards an income related need if you already won that game on the income side. Meaning, if you already have enough cash flow, if let's say you have pension income and you have rental income and you have Social Security income, well, does it make sense at all to take monies from the 401k and add additional dollars towards an income related strategy? Or do those 3 contacts of cash flow, do they already accomplish your need? So that's why each situation is going to be different, to make sure that, okay, you're customizing everything to either the proper IRA strategy for income, or could you move on to that emergency and that growth related need? And then also not accounting for taxes and conversion opportunities. So simply put, if let's say you retire and you have a traditional 401k account, well, those monies that have never been taxed before. So now when you start, any dollar that you pull out and you're taking it from your 401k, you're taking it from your IRA, and you're placing it into your checking savings account, that's taking it from a qualified account into a non-qualified account. When you do that, your money, your withdrawals are going to be taxed at ordinary income. So if you take out $100,000 in a year, well, now you have to incorporate that. Oh, that's as if I made an extra $100,000 this year. What is the tax rate at that point? So what individuals do is, as they start nearing retirement, or they know that date, or they're currently in retirement, how can I effectively create Roth conversion strategies, something known as incremental Roth conversions, that could take your dollars from the qualified status and you're transferring them from traditional IRAs into Roth IRAs, and you're converting those dollars over so that eventually all your monies are going to be sitting in a tax-free bucket, so that now every dollar that you're pulling out, if you take out that $100,000 or if you take out that $60,000 of income or $20,000 of income that's coming you tax-free, you don't have to worry about what the tax rates are in the future because those dollars are sitting in a tax-free bucket. So those are some different things. You just want to make sure that you're understanding all the different opportunities at your fingertips. And when you stop working and you now have access to that 401k account, there's dozens and dozens of opportunities and thousands of strategies available to you. So now I'm going to go through a couple of different examples on how to create effective solutions for 401k situations. So let's say we have an individual that's age 65. They are near retirement or they just recently retired. They have access to their 401k account and they're looking to roll it over. We'll use that same $500,000 example, and we understand that they have $40,000 of Social Security income, but their expenses are $60,000 per year. They don't have any sort of pension. All they have is they have some dollars sitting in savings, but the bulk of their dollars is what they've accumulated in their 401k account. Can we accomplish this goal? Well, it really depends on how much risk this individual is willing to take. Because if, let's say, you want to go more risk-free and you want to leverage something that will produce the necessary cash flow and leverage really strong companies such as insurance companies and banks, that's where you could go more towards the fixed-related accounts such as bank CDs, fixed annuities. If you want to leverage a lifetime income stream, you could leverage fixed index annuities with income riders or income guaranteed annuities, whether that's immediate or deferred annuities, different things that will make sure that you can never outlive those retirement savings. So with the ration of dollars at the $500,000, if that means creating a really safe strategy off of $100,000, $200,000 to place into that customized IRA that is now set up for that lifetime income cash flow, that could be step one. Step two, if that individual has about $60,000 worth of expenses and they have the bulk of the dollars sitting in the 401k, well then maybe they should take $50,000, put into an IRA number 2 that's set up with a money market account. Something that could be a high yield money market saving strategy, something that's not going to be tied to the market, so it's going up, going down, it's just something that's going to be safe and consistent in there. But monies that you're very liquid that you could touch at the drop of a hat. So now that deals with step 2, and now step 3 could be more in line with saying, okay, if I already have my income related need is covered, my emergency need is already covered, well now I could take on a lot more risk on that growth strategy. So that $250,000 that's remaining, maybe you could create different Roth conversion related strategies. You could leverage different types of investments based on what your risk capacity is to have the highest quality blend at the cheapest possible cost. Too often, individuals make the mistake that they leverage an accumulation strategy for their decumulation needs. So what I mean by that is when somebody's working for a company, they understand I'm placing dollars aside, I'm contributing to this 401k account, it's growing with the markets ebbing and flowing, but the next paycheck, I'm just going to constantly be putting dollars in there, putting dollars in there, putting dollars in there. Well, when you're no longer working, you're no longer adding dollars into that account. So now you're removing dollars from that account. So that volatility that takes place, if you start removing dollars from a point where the market's going down and you're having a bearish run, well, you're removing dollars from an account that could potentially go down. And then on top of it, individuals try to leverage really expensive mutual funds to put further harm to their portfolios and further compound interest against their portfolios. And it's known as reverse dollar cost averaging. So you have to understand that there's a difference between an accumulation versus the decumulation phase. It goes from wealth accumulation to wealth preservation and distribution. So that's why by making sure that your areas are padded up properly, you could still leverage the investments, but use the investments in the most efficient manner. And you could say, hey, this investment portion, this growth portion is for my inflation protection. It's for my tax allocation strategies. It's for making sure that I'm getting as much tax-free income later. I'm using this bucket to therefore pay the taxes if I do leverage any sort of conversion opportunities. Also, you could leverage it of, okay, I had a great growth this year. Excellent. Me and my spouse, me and my family, we're going to take an extra trip. We're going to take an extra cruise. Whatever that case is, whatever you see as your dream retirement, that's how it's possible by making sure that you're segmenting your goals properly and you're using the most efficient lane. I always say it's like individual tools on a tool belt. If you're trying to hammer in a nail, can you use the back of a screwdriver? Yes. But won't it be a lot more effective to just use a hammer? You could hit it with a couple of times and it'll go right in place. Same thing. If you're trying to leverage an income-related strategy, don't use a growth-related tool. If you're trying to leverage a growth-related strategy, don't use an income-related tool. So, and there doesn't have to be this one-size-fits-all type solution. That's typically where we see retirement disaster, because when you're using income-related strategies, the negatives to that is you're going to have restriction on your liquidity. But the positive side of it is you're going to have that peace of mind that regardless of whatever's happening with the market, you're still going to be getting that retirement paycheck every single month, every single year, like clockwork to the day that you and your spouse pass away. When we fast forward a little bit further and we're leveraging these growth strategy properly, well, those are dollars that are now your ancillary, your fund monies. But what happens when you pass away, you could have portions of dollars that are being set aside for your estate planning strategy to maximize out that inheritance. So there's so many different ways to skin that cat. And that's what we try to do. We try to take all that complexity and simplify it. And that's where leveraging myself, leveraging my company at Fosse Financial Group and retiresharp.com, we're offering a 25-minute connection call. Simply put, how this process works is you call the 1-800 number. I'll also have a link to our calendar link embedded in the description of this video, but you call 1-800-566-1002. You'll ask to speak to a specialist based on the video that you watched through our YouTube channel. And you'd say, okay, I recently retired. I want to leverage my 401k the proper way. So you tell exactly what the customer service reps are going to be taking the calls, tell them exactly what your needs are, and they would set you up with the correct advisor. It might be myself, it might be one of my other advisors, but from there we would have that connection call so that you're able to be at the convenience of your own home. If you feel more comfortable having a video conversation and just see exactly what you're doing right now, some of the results that you've been getting, to really see what that gap possibly looks like. Based on if there is a gap there, if there's something that we could add some value to you, then we'll make some recommendations. If not, then we're going to tell you, hey, stay the course. There's no reason to change anything. What you're set up in is perfect. So I hope that all of that makes sense. I really hope that you enjoyed this video. You got some good content from there. And once again, watch some of the other videos. Make sure to subscribe to Retire Sharp, and so you could be have access to our most updated videos. But feel free, if you want to have a conversation, 1-800-566-1002. Thanks so much, guys.